Welcome to the MOOC, Money, Mind and Markets, the Science of Financial Literacy. In the week 6, the future of finance, let us navigate the financial life cycle, the behavioral pitfalls and the economics. So, the contemporary Indian financial landscape is undergoing a radical transformation, driven by the shift from the traditional risk-averse saving behavior to the market-linked wealth creation. For the modern Indian investor, achieving financial independence is no longer a matter of simple frugality. It requires a sophisticated understanding of the money, mind and markets trade. So, this concluding lecture examines the structural evaluation of the financial life cycle in India with the emerging criticalities in the financial gerontology and the psychological mechanisms that frequently derail the long-term prosperity. So, by synthesizing the current macroeconomic data with behavioral insights, the following analysis. This lecture will provide a framework for delivering the financial literacy that moves beyond basic numeracy to encompass the cognitive resilience and the strategic planning. If you understand the evolution of the Indian more so with the cultural and economic stages of the financial life cycle in India is not merely an individual journey, but a family-centric progression that reflects the deep-seated cultural milestones and shifting economic realities. While traditional models often divide life into 4 distinct phases like accumulation, perseverance, preservation, the distribution and legacy, the Indian context necessitates a more granular approach that accounts for unique spending peaks such as weddings, multi-generational education funding and the rising cost of the urban living. So, if you recall, in our financial life cycle stage, we have discussed the family formulation and the initiation stage starting from 25 to 35. The initiation stage begins when an individual enters the workforce, often between the ages of 20, 22 and 25. Then comes the family formation stage, where income is typically at its more of rising level and the capacity to withstand risk is at strong. So, in the Indian scenario, this phase is characterized by 2 contradictory pressures, the excitement of the first time financial independence and the immediate burden of the debt, often in the form of student loans or housing or automobile loans. So, during this period, the primary financial goals are to be centered on establishing an emergency corpus and preparing for its first major spending peak. Here comes the marriage. So, estimates suggest that the Indian households prioritize building liquidity during this phase, yet many are lured into lifestyle inflation by the ease of credit and the psychological high of a first paycheck. So, financial literacy at this stage is a behavioral enabler. It transforms the act of saving from a core into a strategic tool for the future freedom. So, the 50-30-20 rule of budgeting is a foundational concept that have to be used here, where 50% of income is allocated to needs like rent, EMI or utilities and 30% to the wants like dining out and travel and 20% to be catered to the savings and the investment. If you look at it, the financial milestones with the context, the model and the reality, I have provided one table. So, the first time, the first salary and it is shared with the joint family. What happens? It is dedicated to the debt repayment and it is a very personal lifestyle. And comes the second stage, where is the marriage, it is funded even by the parental savings as well as the ancestral property. Of course, self-funded or leveraged to the personal loans. This is where the high consumerist peak will happen. Next comes housing, which say for example, if the joint family living in the ancestral joint homes, or if it is a nuclear family, early purchase of the urban apartments via home loans by paying EMIs. This is another interesting stage. And then comes emergency fund, dependent on kin for the crisis support, wherein we need to maintain 6 to 12 months of expenses in the liquid funds. So, the family growth on the peak accumulation stage from the ages 30 to 50, it commences as children enter the education system. In India, this is the most financially demanding period of the life cycle. So, there is something called as education inflation in India, particularly for private schooling, professional degrees. This frequently outpaces the consumer price index CPI, requiring aggressive participation in market linked systematic investment plans. If you look at it, the research statistics have shown that by July 2025, the monthly SIP contributions in India has reached a record of 28,464 crore with over 9.11 crore active accounts. This statistic underscores a massive psychological shift among the Indian investors that they are away from the traditional fixed deposits and are moving towards the equity linked wealth creation. However, the growth stage is also where the herding behavior becomes dangerous. New investors often flock to the small cap and mid cap based on the recent performance, past performance, which we call it as a recency bias, as which the SEBI has flagged as a liquidity risk. Financial literacy at this stage helps the investor to solve the behavioral issues by emphasizing time in the market over timing the market and ensuring that insurance portfolios are pure protection like term insurance rather than investment cum insurance hybrid. So, in the maturity and the pre-retirement phase, ages 50 to 60, the maturity stage is characterized by the peaking of the professional earnings and the gradual decline of active household expenses as children begin to start their own careers. So, the focus shifts from wealth accumulation to wealth preservation. For Indian investors, this is the time to clear off the high interest debts such as home loans or education loans and aggressively boost the contributions to retirement by investing in specific instruments like NPS, National Pension Scheme, and the Employee Provident Fund. A significant challenge in this phase is the sandwich generation phenomenon supporting both elderly parents and adult children. That's why called as sandwich generation, who may still be financially dependent. So, this transition to the nuclear families has removed the traditional safety net of shared resources, meaning that the pre-retirees must now plan for their own longevity without expecting the same level of support from their children that they used to provide to their own parents. Not only that, there are sociological and economic drivers of this life cycle transition. The stages of the financial life cycle are profoundly influenced by the broader macroeconomic and sociological factors. So, this integration of the joint family system and the persistent threat of the inflation are the two most powerful forces reshaping the Indian investors' journey. So, when we disintegrate this, traditionally the Indian joint family functioned as a multi-generational economic unit where resources were pooled and social security was an inherent feature of the structure. However, the shift from an agrarian to a service economy has necessitated the geographic mobility, leading to the rise of the nuclear households between 2001 and 2011, and the nuclear families became the dominant household form in India, representing over 52% of the population. So, these factors had an impact on the housing facilities. I am sharing one table with you where you can read the family and the factors that are governing here, the social factors that govern the financial life cycle. So, increased need for the independent ownership and high rent costs are one of the very factors that has led to the financial planning in the life cycle. Not only that, if you look at it, the job market, the service sector jobs require more of individual mobility across the cities and the nations. So, this also has led the erosion of the kinship based support, especially for the child and the elder care. Apart from this, we also have some of the land reforms wherein the fragmentation of the ancestral land makes the traditional livelihood unsustainable. So, the shift from the wage-based income to shift towards the wage-based income, and then it has created the financial asset accumulation stage. Mass media, the global culture has promoted the privacy and the autonomy. So, the greater decision making power, especially with the financial decision making power, has lot of psychological stress in isolation. This transition places the entire burden of risk management, be it the life, be it the health and the disability, on the individual. In the absence of a joint family pool, the emergency fund is no longer optional. It is the first line of defense against the financial collapse. Not only that, we also have the inflation impact. Why middle class families are vulnerable to this inflation? We all know inflation is a hidden tax that disproportionately affects the salaried middle class households. So, if in India, if you look at it, the chronic inflation erode the real value of the wages, the salaries, altering the consumption habits and forcing the families to put off the long-term investments. The rising costs of food, fuel and health care meant that nominal income growth rarely translates into an improved standard of living. So, for the Indian investor, the inflation necessitates a shift in the asset allocation. Traditional instruments like gold, the which households holds to hold 11% of their wealth in, and the real estate, where earlier there used to be 77% of the wealth in the real estate, often fail to provide the so-called liquidity or the consistent inflation adjusted returns that are required for the distribution phase of life. Statistical data from the RBI Household Finance Committee has highlighted that less than 5% of the Indian wealth is currently in equities, mutual funds and bonds, indicating a massive vulnerability to the erosion of buying power over 20 to 30 years of the retirement. So, the economics, the financial gerontology, the psychology of aging in India has undergone a dramatic demographic transition. So, the field of financial gerontology, which is nothing but the study of the intersection of aging and the wealth management, has become critical. So, India's senior citizen population is projected to double from 100 million in 2011 to 230 million by 2036, exactly 10 years now on. So, eventually reaching 319 million by 2050. So, there comes the longevity risk and the healthcare costs. Increased life expectancy is reshaping the financial life cycle. While living longer is a human achievement, it also introduces the longevity risk, the danger of outliving one's financial resources. In India, the elderly face multifaceted challenges, including inadequate social security and a widening urban-rural divide in the geriatric care. So, healthcare costs represents the largest threat to the wealth preservation in the later life. Only 12.4% of adults over 65 have no chronic health conditions or absent of chronic health conditions, while 63.7 manage 2 or more like BP or sugar. So, in India, the Ayushman Bharat scheme has recently extended 5 lakh per year coverage to all citizens aged 70 plus, regardless of income, a crucial step in preventing financially devastating the medical expenses. However, the cost of specialized care for conditions like Alzheimer's and dementia, which are increasingly stigmatized yet prevalent, remains a significant private burden. Not only that, the psychological dimensions of the aging also encompasses this financial gerontology, because as one managing wealth is a cognitive function declines as one ages. So, as individuals age, their ability to navigate the complex financial products or detect digital scam often diminishes. This cognitive aging requires the simplified investment strategies and the early appointment of nominees or the creation of wills. Furthermore, the gender nature of aging in India is at stake. Women make up 58% of the elderly population and 54% of these women are widows. So, many of these women have historically been excluded from financial decision making, leading to a capability gap even when they have the access to the bank accounts. So, financial literacy for the elderly must therefore focus on digital security, estate planning, and ensuring that survivors have the skills to manage inherited assets independently. I'll be sharing one demographic statuses about the current status projections and the financial implications. For example, the senior citizen population by 2036 has 230 million, that is 15% of the total, wherein there is a massive increase in demand for pension and annuity products, and the dependency ratio of 62 dependents per 100 working age individuals. So, increased tax burden and pressure on private savings. If you look at Atal Pension Yojana APY subsidy scheme of 8.27 crores as of October 2025, there is still the need of growing awareness of the structured retirement income. There is a longevity gap, as we discussed, the higher income up to 15 years longer life. So, wealthy families must plan for 30 plus years of the retirement income. Learners, is the time to reflect. Based on the data, if the traditional support of the joint family is disappearing, what are the 3 non-negotiable financial steps your parents should take to ensure their independence at age 80? This is for the learners from 18 to 24. Think about if you are about 25, what are the steps you will be considering, right? So, with this, the foundations of the financial independence, the mind over the markets achieve the financial independence. FIT, in this context, in Indian context, requires a framework that integrates math with psychology. The course Money, Mind and Markets, we have suggested that success is defined not by the best product, but by achieving unique personal financial goals. So, one should calculate the 5 number and goal based investing. The first step is to define what it means to you. A practical framework involves calculating the financial independence and retire early. And latestly of late we have coming with one term fiber, financial independence, build and retire early number. The corpus that is required to sustain your lifestyle indefinitely. So, this requires a deep understanding of what is the required rate of return. The return, that means it is the return your portfolio needs to earn to meet your specific goal, accounting for tax as well as for inflation. Next comes asset allocation, the mix of shares, the bonds and the cash. Statistics shows that asset allocation drives over 90% of a portfolio's performance variability, yet investors often waste time choosing the individual stocks. Next important factor is the real returns. Understanding that if inflation is 6% and your bank FD gives 6.5% or to 7%, say, your real return is only 1% before the taxes. Here comes the financial literacy. The role of financial literacy in solving these behavioral issues. As we discussed earlier, financial literacy acts as a behavioral enabler. It provides the cognitive tools to recognize even when emotions like fear or greed are driving the financial decisions. Studies in Mumbai and Bangalore have shown that while financial literacy levels are often moderate, behavioral biases remain widespread, significantly impacting the saving and the investment outcomes. To quote an example, mental accounting causes people to treat a 1 lakh bonus differently than 1 lakh of salary. So, financial literacy helps the investors realize that money is fungible. That means it has the same value and should be allocated based on the overall financial plan rather than its source. Similarly, automation through SIPs help overcome the decision fatigue and the emotional roller coaster of trying to time the market. So, the Indian investor should understand the behavioral finance pitfalls. Once, if you appreciate the and aware of the behavioral finance that integrates the cognitive psychology with the financial theory, explains why investors make rational choices. So, in India, several specific biases are exacerbated by the social media, like almost like we have the WhatsApp University and the recent democratization of the trading apps and the rise of the influencers. So, herding behavior and the FOMO factor. Herding, the tendency to mimic the actions of the majority, often ignoring the personal research. This is rampant in Indian IPO rush for companies like Zomato or Paytm, where retail investors rushed in because of the media hype rather than working on the fundamentals. So, research has indicated that herding behavior is especially prominent during the market volatility. In Bengaluru, a study found that retail investors often anchor their expectations to previous 52-week highs, leading them to hold on to the declining stocks in the futile hope for the recovery, a combination of herding and anchoring biases. Not only that, in the digital age, telegram groups and influencers have intensified these patterns, leading to over speculation, especially in the derivative segments. If you recall, we have discussed that 89% of the retail participants have lost money in the F&O segment. And then comes the overconfidence and the illusion of the control. Overconfidence occurs when the investors overestimate their predictive abilities. This is particularly relevant among Gen Z and millennial investors in India who exhibit this behavioral bias, this by scoring 1.38 units higher than the Gen X. These younger investors often believe they can time the market or outperform the professionals through active trading apps like Zerodha or Growth. However, statistics have shown that in 2023, only 25% of actual mutual funds outperformed the market over a 10-year period. So, literacy intervention at this stage involves teaching the students the humility of the index, acknowledging that staying in the course in the long run is more profitable than the frequent trading. Important behavioral bias which we address is the loss aversion and the dispersion effect. If you recall, based on the prospect theory, the pain of losing 1000 rupees is psychologically twice as intense as the joy of gaining 1000 rupees. This leads to the disposition effect, that is, selling winners too early to feel the pleasure of a gain, or while holding on to the losses too long to avoid the pain of realizing a loss. Indian investors culturally prefer tangible assets like gold and real estate, partly because they are less volatile in terms of daily pricing, so which helps them to avoid the constant psychological pain of seeing a portfolio dip in the value. So, we have addressed these behavioral biases, the mechanisms in various contexts. To quote one example, herding, following the crowd to avoid FOMO, invest in small cap funds after a 50% rally. Overconfidence, inflated belief in one market skill, we should all surge in the retail for F&O trading despite the losses. And we also saw the anchoring effect, which is relying too much on the first piece of the information and refusing to sell a stock because it was once 500 rupees. And we also discussed about the loss aversion, that is preferring avoiding the losses over the making of the gains. So, keeping your money in a savings account at 3% while inflation is 6%. And the most important is the mental accounting, where we have segregated the money into different jars, different buckets. Like sometimes people commit the mistakes using a tax refund for a luxury watch instead of debt repayment. Learners, here is a reflective question for you. Think of the last time you bought a product because everyone else had it. Remember, this was the first question where we started our week 2. Have you done any research on whether it was the best value for your money? How might this same herd mentality damage your retirement fund for 30 years from now on? I would request you to read the module 2 in the course, The Money, Mind and Market, the Science of Financial Literacy, to answer these questions. Let us end this course with one reflective exercise called as a financial self-audit. First stage, identification of the stage. Which stage of the financial life cycle am I in? What is my most pressing financial need this year? And then go with the bias check. Have you ever made a financial decision based on a WhatsApp forward or a friend's advice? If yes, means you have experienced the herding. And then inflation awareness. If I save 10,000 rupees in a 3% savings account and inflation is 6%, how much real wealth am I losing every year? Then, does my family have a plan for elder care that does not involve selling the family home? That is the legacy and care. So, financial literacy is a solution to all the behavioral issues. The relationship between financial literacy and the behavioral biases is complex. While literacy, the knowledge of interest rates, inflation, and diversification is essential, it is often insufficient to overcome instinctive cognitive biases. A recent one of studies of 348 participants in India has demonstrated that even as the literacy scores improved, the biases like overconfidence and anchoring remained resilient. So therefore, the money, mind and markets, the science of financial literacy, MOOCs has approached advocates for behaviorally informed investor training. So this involves the visualizing the scenarios, predicting to 30% market drop and planning a logical response in advance to avoid panic selling, that is the loss aversion mitigation, and imagining a future market where an investment has failed and identifying the reasons why today. In simple sense, pre-mortem exercises to overcome the overconfidence mitigation. Next scenario can be using the default diversification and target date funds to overcome the status quo bias. Is a simplified option where people simply do nothing because they are overwhelmed. So, in the Indian context, the surge in SIP adoption, 61% among the high literacy youth versus 24% among the low literacy peers, is the strongest evidence that financial literacy fosters the disciplined long-term behavior. Financial literacy provides a rational anchor that prevents an investor from being swept away by the market noise. So, the path to the resilient future is a question. If the path to resilient future is a question, our MOOC is the answer. So, the Indian financial life cycle is no longer a predictable path. It is a journey through a landscape of rising costs, increased longevity and the psychological traps. The transition to a super aging society by 2050 means that today's youth must be more financially literate than any generation in the history. So, financial independence is not about the pursuit of more, it is about the provision of enough to ensure the dignity across the entire life cycle. So, by understanding the financial stages, the life, the economic factors that influence them like inflation, nuclearization and the behavioral biases that derail them, the Indian investor can move from being financially included to be financially empowered and to the financial independent. So, the integration of the financial gerontology ensures the empowerment lasts in the golden years of the life, turning the demographic challenge of aging into a demographic dividend of stability and well-being. We have discussed the strategies for you in the following table. So, one should understand these strategies and take up the action plan for to have become the financially independent. Like simple techniques like budgeting technique, maintaining the emergency fund can answer the basic questions of the financial lifestyle. So, in this MOOC, we have tried to integrate the 3M framework, the money, mind and the markets in the science of financial literacy to make you the more financial independent. Are you financially independent? Fit for the income, finance, insurance and taxation aspects? Yes. Finance is fitness, earn, save, invest and retire. So, this is our course for you, the 3M framework, money, mind and markets, the science of financial literacy. Dear learners, are you fit? Finance is fitness, earn, save, invest and retire. Means you are well informed of finance, insurance and taxation to become financially independent. Happy learning. Namaste. Thank you for being a part of my journey, our journey in this MOOC course, 3M framework. Namaskar.